Hello everyone and welcome to Chapter 4 of Intermediate Accounting. So this chapter is going to have three primary goals: to consider important issues dealing with the content, the presentation and disclosure of net income, and other components of comprehensive income. It's also going to provide an overview of the financial statement of cash flows and then examine common ratios we're going to use in profitability analysis. So the income statement reports a company's profits during a particular reporting period. Profits equal revenues and gains minus expenses and losses. So a few types of gains and losses are excluded from the income statement but are included in a broader concept of comprehensive income. We refer to these other gains and losses as other comprehensive income. The statement of cash flows provides information about the cash receipts and cash payments of a company during a particular reporting period. The difference between cash receipts and cash payments represents the change in cash for the period. To help investors and creditors better understand the sources and uses of cash during the period, the statement of cash flows distinguishes among operating, investing, and financing activities, as all companies, their activities can be linked into one of these three activities. So before we talk about specific components of an income statement in a lot of depth, let's take a quick look at the general makeup of the statement. Here we look at an income statement for McAllister's Manufacturing. It's a hypothetical company. At this point, our objective is really to gain a general perspective on the items reported in the classifications contained in corporate income statements. In each income statement, you should include the heading, the name of the company, the title of the statement, and the date or time period. McAllister's income statement is for the year ended December 31st. So this means that amounts in the income statement are the result of transactions from January 1st to December 31st of that year. Now, many companies have reporting periods, often referred to as a fiscal year, that end in months other than December. Shown here are comparative income statements for 2 consecutive years. Let's look closer at the components of net income. Then we'll see how net income fits within the concept of comprehensive income and how comprehensive income gets ultimately reported. Unlike the balance sheet, which is a position statement at a point in time, the income statement measures activity over a period of time. The income statement reports the revenues, expenses, gains, and losses that have occurred during the reporting period. Revenues are inflows of resources resulting from providing goods or services to customers. Expenses are outflows of resources incurred while generating those revenues. They represent the cost of providing those goods and services. When recognizing expenses, we attempt to establish a causal relationship between revenues and expenses. If causality can be determined, expenses are reported in the same period that the related revenue gets recognized. If a causal relationship cannot be established, then we relate the expense to a particular period allocated over several periods, or we'll just expense it as incurred. Gains and losses are increases or decreases in equity from peripheral or incidental transactions of an entity. In general, these gains or losses result from changes in equity that don't result directly from operations, but nonetheless are related to those activities. So an example would be the sale of equipment, buildings, or other operating assets for an amount that differs from their recorded amounts results in a gain or in a loss. So this slide helps us understand a company's ability to generate cash in the future. Investors and creditors assess which components of net income are likely to continue into the future. Income from continuing operations includes revenues, expenses, including some taxes, gains, losses arising from operations that are more likely to continue in contrast. Income from discontinued operations won't continue into the future. The main three components of income from continuing operations are operating income, non-operating income, and income tax expense. So operating income includes the revenues and expenses directly related to the primary revenue generating activities of the company. As shown here, operating income is often presented as gross profit, which would be the sales minus the cost of goods sold, minus other operating expenses. Non-operating income relates to the peripheral or those incidental activities of the company. As you see on this slide, non-operating items often are included in the income statement under a heading Other Income or Other Expenses. Now, income taxes are levied by taxpayers in proportion to the amount of taxable income that is reported to taxing authorities. Because of the importance and size of income tax expense, it's always reported in a separate line in corporate income statements. When tax rules and GAAP differ regarding the timing of revenues or expense recognition, the actual payment of taxes may occur in a different period from when income tax expense does get reported on the income statement. Here we see the 2015 income statement for Sherwin-Williams, a company that manufactures paint. You see that Sherwin-Williams distinguishes between operating income, non-operating income, and income tax expense. Operating income includes revenues and expenses from primary business activities relating to producing and selling paint. After operating income is determined, then the non-operating items are added or subtracted to arrive at income before income taxes. For a paint manufacturer like this company, activities related to interest and investments are not primary operations, so they're listed as non-operating items. Then we have income tax expense, which is subtracted to arrive at our net income. Let's take a look here at a company. Pandora Corporation operates several factories in the Midwest that manufacture consumer electronics. So the December 31st year-end trial balance contained the following income statement items. Our job is to calculate the company's operating income for the year. So as you see here, the operating income may exclude some of these items above. What we're going to show, we start with sales, less our operating expenses. We start at cost of goods sold. Then from there, selling, general and administrative expense, and research expense. Those items alone we take to arrive at operating income. The income expense is going to be done on a separate line item, as will the income tax expense. Now, this slide shows that there's not a specific standard that dictates how income from continuing operations gets displayed. This flexibility has resulted in a variety of income presentations, but we can identify two approaches. We call one the single step, then the multi-step formats. So the single step format, as we just did in that earlier exercise, lists all the revenues and gains included in income from continuing operations. Then expenses and losses are grouped, subtotaled, and subtracted in a single step from revenues and gains to come to income from continuing operations. In a departure from that, though, companies usually report income tax expense in a separate line in the statement. Operating and non-operating items aren't separately classified. So this slide here is an example of a single-step income statement for this hypothetical manufacturing company, Maxwell Gear. Now, a multi-step income statement format reports a series of intermediate subtotals, such as gross profit, operating income, and income before taxes. Most of the real-world income statements are using this format. A primary advantage in this multiple-step format is that by separating the operating and non-operating items, it provides information that's useful in helping to analyze trends. The classification of expenses by function also provides useful information. It's important to note that the difference between the single-step and the multiple-step income statement is one of presentation. The bottom number, net income, is going to be the same no matter what format you use. There are more similarities than there are differences between income statements prepared according to GAAP and those prepared applying the international standards. But some of the differences are the international standards require certain minimum information to be reported on the face of the income statement, while GAAP doesn't have those minimum requirements. International standards allow expenses to be classified either by function, like cost of goods or general and admin, or by natural description, like salaries, rent. The Security Exchange Commission's regulations require expenses need to be classified by function. In the U.S., the bottom line of the income statement usually is called either net income or net loss. The descriptive term for the bottom line of the income statement prepared according to international standards is either profit or loss. So let's take a look at this question for you. Which of the following captions would more likely be found in a single step income statement? Would it be A, total revenues and gains, B, gross profit, C, operating income, or D, all of these answers are incorrect? Well, A would show income statement groups together all revenues and gains. Next, let's take a look at exercise 4.2. The following is a partial trial balance for Greenwich Corporation as of December 31st, year 1. So it gives us our revenues, some gains, cost of goods, and various expenses. It also tells us 178,500 shares of common stock were outstanding throughout year 1. We're going to prepare a single step, then we're going to prepare a multi-step, and we are going to include the earnings per share disclosures. So as you see in the single step, we're going to link our gains together, and then we will link our expenses and losses together to derive at net income. From there, we will take the number of shares and take our net income, we will divide it by the number of shares outstanding to derive at earnings per share, which will be $1.67. If we use the multiple step income statement, we are going to have several layers in this income statement. We start with our sales minus our cost of goods sold to get us to gross profit. From there, we take our operating expenses to come up with operating income. From there, we take our other income or expenses, which would include our interest revenue, our gains, and expenses, to come up with income before our income taxes. Then we take our income tax expense to arrive at net income, as you see, the earnings per share is going to be the same. The results are the same. It's just the manner in which we present the information. Next, you'll see a partial trial balance for Tucson Star Corporation. We show 413,000 shares of common stock were outstanding, and income tax expense hasn't been recorded yet, but we know the rate is 35%. So basically it's asking us to help compute that information. So in a single step income statement, what we will do is take our revenues and gains and combine them. Then from there, our various expenses. So as you see here, we will have to come up with all of our various expenses before we come up with our income before income taxes. From that income before income taxes, we then apply the 35% rate to come up with our net income. Again, our net income divided by the number of shares outstanding would give us our earnings per share. Again, if we use the multiple step income statement, we will have various categories, starting with our gross profit, which is derived from sales minus our cost of goods sold, then our operating expenses, which ultimately then come up with our operating income. From there, we take our other non-operating items, such as interest revenue, losses on investments, or interest expense, to have total other income. Ultimately, this derives income before income taxes. We take our income tax expense, and after that come with our net income, our bottom profit. From there, you see the same earnings per share is going to be calculated no matter which method we use, the single step or the multiple step. Now, investors, creditors, and financial analysts are concerned with more than just the bottom line of an income statement, net income. The presentation of the components of net income and the related supplemental disclosures provide clues to the user of the statement in an assessment of various types of earnings quality, we call them. Now, earnings quality is used as a framework to help greater in-depth discussion of what there are as far as operating and non-operating types of income. One meaning of earnings quality is the ability of reported earnings to predict a company's future earnings. So the relevance of any historical-based financial statement hinges on its predictive value. To enhance predictive value, analysts try to separate companies' temporary earnings from its permanent earnings. What are these temporary earnings, and what are permanent earnings? Well, temporary earnings reflect results from transactions or events that aren't going to probably occur again in the foreseeable future, or that they're likely to have a different impact on earnings in the future, while permanent earnings relate to operations that are expected to generate similar profits in the future. Analysts begin their assessment of permanent earnings with income before discontinued operations, which is income from continuing operations. It would be a mistake to assume that all items included in income from continuing operations reflect permanent earnings, because some income items that fall under that category could be temporary in a sense. The label continuing could at times be misleading. An often debated contention is that within GAAP, managers have the power to change reported income by altering assumptions and estimates. And these estimates are not always in the direction of higher income. Survey evidence suggests managers often alter income upwards in one year and then downwards in other years. So, for example, In a year when income's high, managers may create reserves by overestimating certain expenses like future bad debts or warranties. And these reserves reduce the reported income in that current year. Then in later years, they can use those reserves by underestimating expenses, which will increase reported income. So by shifting income in this manner, the managers smooth the pattern in reported income over time. And by doing this, they portray like there's a steadier income stream to investors and creditors. So management's income smoothing behavior can be controversial. While some believe a smoother income pattern helps investors and creditors predict future performance, others think that managers are doing this to really hide the true risk of operations. By hiding this underlying volatility, by what they call manipulating the income pattern, managers could be fooling investors and creditors into thinking that the company's operations are lower risk than they really are. Another way managers affect reported income is through classification shifting in the income statement. So the most common example of this involves misclassifying operating expenses as non-operating expenses. So by shifting operating expenses to a non-operating classification, managers report fewer operating expenses and therefore higher operating net income. This type of manipulation creates the appearance of stronger performance for the core reason the company's in business. While bottom line net income remains unaffected, investors and creditors may think the core business could be stronger than it really is. Let's look at a question here for you. What are temporary earnings? A, earnings from transactions that are not likely to occur again in the foreseeable future. B, earnings from transactions that are likely to generate similar profits in the future. C, earnings from transactions likely to have a different impact on income in the future. D, both A and C. Well, the answer is D. Temporary earnings affect results from transactions or events that are not likely to occur again in the foreseeable future, or might not have, likely not to have a big impact on earnings in the future. So, should all items of revenue and expenses included in operating income be considered indicative of companies' permanent earnings? Not really. Sometimes a company will have an unusual or an infrequent event. Even though these events may be unlikely to occur again, we report them as part of operating income because they're so closely related to the company's core business. What kind of items could be included in this category? We'll look at the income statement here of Hershey Company, the largest producer of quality chocolate in North America. Which items appear unusual? Well, we know it's not net sales or cost of sales or selling, marketing, and admin expenses, but what about goodwill and other intangible asset impairment charges and a business realignment charge? Let's look at both of these. So it's not unusual for a company to reorganize its operations to get some greater efficiency, but when this happens, the company often incurs some significant restructuring costs. Sometimes we refer to them as reorganization costs. These restructuring costs are associated with management's plan to materially change the scope of business operations or the manner in which they're conducted. For example, facility closings, related employee layoffs translate into costs incurred for severance pay and relocation costs. The Hershey Company had restructuring costs related to reorganization of operating expenses in Brazil to enhance distribution of the company's products, as well as employee severance costs related to getting rid of several positions as part of the company's productivity initiative. So these restructuring costs are recognized in the period the exit or disposal cost obligation actually gets incurred. So suppose as part of a restructuring plan, employees to be terminated are offered various benefits, but only if they complete a certain period of work for the company. In that case, a liability for termination benefits and corresponding expense would be accrued in the required periods of work. On the other hand, if future work by the employee is not required to receive the termination benefits, then the liability and the corresponding expense for benefits are recognized at the time the company communicates the arrangements to employees. Costs associated with closing facilities and relocating employees are recognized when goods or services associated with those activities are received. Because it usually takes considerable time to sell or terminate a line of business or to close a location, many restructuring costs represent long-term liabilities. GAAP requires initial measurement of these liabilities to be at fair value, which often is determined as a present value of future estimated cash flows. Companies also are required to provide many disclosure in the notes, including the years over which the restructure is expected to take. Two other expenses in Hershey's income statements that warrant some additional scrutiny are goodwill impairments and asset impairments. Any long-lived asset, whether tangible or intangible, should have its balance reduced if there's been a significant impairment of value. These aren't the only components of operating expenses that call into question this issue of earnings quality. So, for example, the write-down of inventory that can occur with obsolete or damaged inventory. And then other possibilities would include losses from natural disasters like earthquakes and floods, gains and losses from litigation settlements. So earnings quality is influenced by the way a company records income from investments and accounts for its pension plans. Earnings quality is often affected by revenue issues as well. Like suppose that toward the end of a fiscal year a company loses a major customer that it can't replace. Well, that would mean the current year's revenue numbers include a component that's not going to occur again next year. In addition to its effect on revenues, losing the customer would have implications for certain related expenses and net income. Another issue affecting earnings quality is the intentional misstatement of revenue. Companies also misstate revenue by accelerating the timing of its recognition. This happens when companies record revenues before actually performing its obligations to the customer. Most of the components of earnings in an income statement relate directly to the ordinary continuing operations of the company. Some, such as interest, gains or losses on the sale of investments or property, are only tangentially related to normal operations. We'll refer to these as non-operating items. So how should these items be interpreted in terms of their relationship to future earnings? Well, are these expenses likely to occur again next year? You see, investors need to understand that some of these items may recur, like interest expense, while others are less likely to recur, such as gains and losses. So this slide shows Home Depot's partial income statement, and it shows two non-operating amounts reported after operating income. The first one is interest and investment income that primarily includes gains on the sale of investments in another company's stock. Because Home Depot's primary business includes selling home improvement products, sales of investments aren't considered normal operations. So Home Depot reports these amounts as non-operating items. Home Depot disclosed in the notes of its 2016 and 15 reports that gains on the sale of investments were $144 million and $323 million respectively, Once these investments are sold, their gains aren't to continue in the future into future profitability, so investors would not consider these gains to be permanent components of profit. The remaining relatively minor amount in this non-operating category comes from interest income. Another large non-operating item reported by most companies is the interest expense. In its 2016 report, Home Depot reported there was $919 million in interest expense. The company also reported long-term debt of nearly $21 billion in the balance sheet. Because this long-term debt will not be repaid for several years, the company will have to pay interest for many years. So the interest expense represents a type of non-operating item that's expected by investors to be a more permanent component of future profitability. Companies are required to report earnings based on generally accepted accounting principles. This number includes all revenues and expenses. Most companies, however, voluntarily provide non-GAAP earnings when they announce annual or quarterly earnings. So non-GAAP earnings exclude certain expenses and sometimes certain revenues. Common expenses excluded are restructuring costs, acquisition costs, write-downs of impaired assets, and stock-based compensation. Now, non-GAAP earnings are management's view of permanent earnings, supposedly, in the sense of being a better long-run measure of its company's performance. Nearly all major companies report non-GAAP earnings. Non-GAAP earnings are controversial because determining which expenses to exclude is at the discretion of management. By removing certain expenses from reported non-GAAP earnings, management's got the potential to really mislead by showing higher profits. The Sarbanes-Oxley Act addressed these non-GAAP earnings in its Section 401. One of the Act's important provisions requires that if non-GAAP earnings are included in any periodic or other report filed by the SEC or in any public disclosure or press release, the company also must provide a reconciliation with earnings determined according to GAAP. So let's take a look at a question for you. Buffalo Manufacturing Company's restructuring and closing the platinum mining division. The mine will be closed and its assets sold off over the course of the next 3 years. When should the costs related to closing of the mine be recognized? Would it be A, in the year the restructuring plan is announced to the board of directors? B, in the years the costs are actually incurred? C, in the year the restructuring is complete? Or D, all of these answers are incorrect? Well, restructuring costs are recognized in the period the exit or disposal obligation actually is incurred. Let's take a look at exercise 4.4. The trial balance for Sumais Corporation, a manufacturing company, for the year ended December 31st, year 1, included the following income accounts. The trial balance does not include the accrual for income taxes. Sumais' income tax rate is 25%. 1 million shares of common stock were outstanding throughout year 1. So we're to prepare a single, continuous, multiple-step statement of comprehensive income for year 1, including the earnings per share disclosures. So the way we'll handle this is we're going to start by showing our sales revenue, then our cost of goods sold, which will then give us our gross profit. From there we take our operating expenses to come up with operating income. From there we come up with our other expenses, interest expense, That gives us income before taxes of $804,000. Next, we compute our income tax expense as it was given to us at 25% to then come up with net income. Now we include our other comprehensive income, which would be the unrealized holding gains of investment securities, to then provide the bottom number, comprehensive income. Our earnings per share is going to be the income divided by the number of shares outstanding, 1 million shares, gives us our 60 cents earnings per share. Now, sometimes a company decides to discontinue or sell part of a business. Discontinued operations get reported when a component of an entity or group of components has been sold or disposed of or is considered held for sale. If the disposal represents a strategic shift that has or will have a major effect on the company's operations and financial results. So for the first item, a component of an entity includes activities and cash flows that can be clearly distinguished operationally and for financial reporting purposes from the rest of the company. A component could include an operating segment, a reporting unit, a subsidiary, or an asset group. For the second item, whether the disposal represents a strategic shift requires the judgment of company management. Examples of possible strategic shifts would include the disposal of operations in a major geographical area, a major line of business, a major equity method investment, or other major parts of the company. Although a company has flexibility in this matter in reporting income and from continuing operations, the presentation of discontinued operations is mandated as shown here in this illustration. The objective of this format is to inform financial statement users of which components of net income are going to continue. So we do this by separately reporting income from continuing operations of $600 and then income from discontinued operations of $60. All else being the same, investors should not expect next year's net income to be $660 because only $600 of profits from this year are part of continuing expenses. Separate reporting includes taxes as well. The income tax expense associated with continuing operations of $400 is reported separately from the income tax of discontinued operations of $40. Also, in the case that there is a loss from discontinued operations, there would be an income tax benefit instead of an income tax expense. Losses from discontinued operations are tax deductible and would reduce overall taxes owed, therefore adding a benefit. So as part of the continuing process to converge U.S. GAAP and international standards, the FASB and IASB have developed a common definition and a common set of disclosures for these discontinued operations. By definition, the income or loss stream from discontinued operations will no longer continue. So financial statement users more interested in the results of their operations that are going to continue, and it's informative for companies to separate the effects of the discontinued operations from the results of operations that are going to continue. For this reason, the revenues, expenses, gains, losses, and income tax related to a discontinued operation must be removed from continuing operations and reported separately for all the years presented. So, for example, even though Abbott Laboratories did not sell its generic pharmaceuticals and animal health business until 2015, it's important for comparative purposes to separate the effects for any prior years presented. This allows to be able to view apples to apples comparison from the continuing operation. So in its 2015 three-year comparative income statements, the 2014 and 2013 income statements reclassified income from generic pharmaceuticals in the animal health business to income from discontinued operations. Also, there was a disclosure note to inform the readers that prior years were reclassified. When the discontinued component is sold before the end of the reporting period, the income effects of a discontinued operation will include two elements: income or loss from operations, which would be the revenues, expenses, gains and losses of the component from the beginning of the reporting period to the disposal date, and then gains or loss on disposal of the component's assets. The first element would consist primarily of income from daily operations of this continued component of the company. This would include typical revenues from sales to customers, and then those ordinary expenses such as cost of goods sold, salaries, rent, and insurance. The second element includes gains and losses on the sale of assets, like selling a building or office equipment of the discontinued component. These two elements can be combined or reported separately net of their tax effects. If they're combined, the gain or loss component has to be indicated. So we're going to see in the next slide how we combine the income effects. So this slide describes a situation in which the discontinued component is sold before the end of the reporting period. Note that an income tax benefit occurs because a loss reduces taxable income, saving the company $800,000 in taxes. Now, on the other hand, suppose Duluth's division had a pre-tax loss from operations of only $1 million and still had a gain on disposal of $3 million. In this case, the combined amount of $2 million represents income from operations of the discontinued component, and the company would have an additional income tax expense of $800,000. What if a company has decided to discontinue a component, but when the reporting period ends, the component hasn't been sold yet? So if the situation indicates that the component is likely to be sold within a year, the component is considered held for sale. In this case, the income effects of the discontinued operation still are reported, but the two components of the reported amount are modified as follows: income or loss from the operations, again those revenues, expenses, gains, and losses of the component from the beginning of the reporting period to the end of the reporting period. An impairment loss of the book value, which we can call the carrying value or carrying amount of the assets of the component, is more than the fair value minus the cost to sell. The two income elements can be combined or reported separately, net of their tax effects. In addition, if the amounts are combined and there's an impairment loss, the loss has to be disclosed either parenthetically on the face of the statement or in disclosure notes. So let's illustrate discontinued operations in a situation when the component is considered held for sale and there's an impairment loss. Duluth Holding Company has generated after-tax profits of $20 million from continuing operations. At the end of the company's fiscal year, the company still hasn't sold the division it decided to sell in October. The assets of the division has a book value of $12 million and a fair value of $9 million. So the impairment loss is calculated as book value less the face value, which is $3 million. For the year, the division reported a pre-tax loss from operations of $5 million. These two components together result in a loss from operations of discontinued component of $8 million. Next, the company's income tax rate is 40% on all items of income or loss. Since in this case it's a loss, the company has a tax benefit. The income tax benefit is calculated to be $3.2 million. The net of these amounts is the loss on discontinued operations, which is $4.8 million. Also, the net of tax income or loss from operations of the component being discontinued is reported separately from continuing operations for any prior year that's presented for comparison purposes along with this 2018 income statement. Then, in the year of actual disposal, the discontinued operations section of the income statement would include the final gain or loss on the sale of the discontinued segment's assets. The gain or loss is determined relative to the revised book value of the assets after the impairment write-downs. Had the fair value of the division's assets minus cost to sell exceeded the book value of $12 million, then there wouldn't be an impairment loss, and the income effects of the discontinued operation would only include the loss from operations of $5 million less the income tax benefit. Now the balance sheet gets affected also because the assets and liabilities of the component considered held for sale are reported at the lower of their book value or their fair value minus the cost to sell. And because it's not in use, an asset classified as held for sale is no longer reported as part of the company's property, plant, and equipment or intangibles and is not depreciated or amortized. So important information about discontinued operations, whether sold or held for sale, is reported in a disclosure note. So the note provides additional details about the discontinued component, including its identity, its major classes of assets and liabilities, the major revenue and expenses that constitute the pre-tax income or loss from operations, the reason for its discontinuance, and the expected manner of disposition if held for sale. The sale of operations of Abbott Laboratories were completed by the end of 2015, but some assets and liabilities of the sold businesses haven't yet been transferred. So the 2015 year-end balance sheet reported $107 million in current assets held for disposition and $373 million in current liabilities held for disposition. Information about the discontinued operations was included in the disclosure notes shown in illustration 4-9. So note the assets and liabilities held for sale are classified as current because the company expects to complete the transfer of these assets and liabilities in the next fiscal year. Let's take another question here. The Kinsella Baseball Bat Company reported income before taxes of $375,000. This amount included a $75,000 loss on discontinued operations. The amount reported as income from continuing operations, assuming a tax rate of 40%, is A, $375,000, B, $270,000, C, $180,000, or D, $225,000. The correct answer here would be B, the $375,000 income before income taxes plus the $75,000 loss on the discontinued operations, and then times a 40% tax rate would ultimately yield the $270,000.